Just a quick follow-up, Mr Chairman, to your last answer. You seem to be suggesting that with the first capital raising last December, you only wanted $3.25 billion. Not a dollar more, not a dollar less. If you'd fallen short, your comments seem to suggest the sky would have fallen in. The rating agencies, bad press, it would be a disaster to announce a figure and to fall short. Equally, if you look at the capital raising in July, you refused to increase the offer. So then you said $2 billion placement to institutions. We only want $750 million from our retail investors, which only represented 27% of the capital raising. So at least you allocated us retail investors an improved amount, up from only 7.7% last December to 27%. Now you've said you want to raise another $1.5 billion to fund this AXA deal, when you returned $1.6 billion to your retail investors in the July SPP. If you had accepted all of those oversubscriptions, as ANZ did in similar circumstances just a couple of weeks earlier, you would have partially redressed the dilution from the December issue, and you wouldn't have had to come back to the market now to raise more money. So my question is, why is NAB the only major financial institution in Australia that insists on imposing caps on SPPs and then sticking to the cap when they get oversubscriptions? ANZ accepted oversubscriptions, Commonwealth Bank, Macquarie Bank didn't impose limits, got much more than they expected, accepted it all with goodwill. Thank you, shareholders. We appreciate your money. So in July, you became the first institution to do a major institution to do a scale back of your retail investors. You may talk about very tiny percentage point movements in the written literature for today's meeting, but that decision has literally cost your retail investors many hundreds of millions of dollars in missed profits, and you are one out in the Australian market in the way you have treated your retail shareholders. And even today, with the capital raising, you've said you want to raise $1.5 billion in a pro rata offer. Yes, pro rata is better than a big preferential, big end of town placement. But with this issue, you could have come back and said, we're going to do a make-up SPP. We need $1.5 billion. We are going to do a retail exclusive offer just for our retail investors who have missed out over the last year by only putting up $1 billion of the $6 billion you've raised. You could have made it up to us, but instead, no, you've gone and just made it equal. You've just gone and done a pro rata, and you know that with pro rata there will be a lower take-up by retail because of inertia, lack of capacity, those sorts of issues. So there will probably be even more dilution. And given a chance to do the make-up, you haven't done it. So my overall question is, what's this obsession with the exact amount of money you have to make, and why are you the only major institution that imposes these caps, and when will you ever do a capital raising that actually dilutes the institutions and gives something back to your retail investors?
Well, Mr Mayne, as I said in my note in the notice of meeting, I think your comments evidence a real lack of understanding of some issues. One is capital management issues in a bank. You suggest that a bank should take more capital than it needs on the basis that it might need it one day down the track. Now, companies don't operate that way because there is a real negative about holding too much capital. If, for example, we had taken that additional capital back in July, for example, the institutions applied for $8 billion worth and got $2 billion, and the retail shareholders applied for $2.6 billion and got $750 million, so they were diluted less than the institutions. But if we'd taken all of that capital, the dividend that we're paying for the next dividend would have been dramatically smaller than it's going to be. You cannot carry more capital than you need. And what you've got to do is say, what's foreseeable here? How much capital should we be carrying? Not too little, not too much, but the right amount. Because if acquisition opportunities come up, the market will be available, if they're good opportunities, to provide you with capital at the time. I mentioned earlier that in the first raising last year, retail shareholders elected to take up almost none of it, and in the second one elected to take up a lot more because they had time to consider it, and during that time the share price went from $22 to $27. We, of course, looked at what other companies had done, and contrary to what you say, only one other bank had actually taken a very large amount, well above what it said it would take. Well, there are a couple of points about that. Firstly, we think it's important that we do what we say we're going to do, and we set out at the start of that and said there will be a limit of $750 on this because we figured that was a sensible and achievable amount and we should stick to it. The Commonwealth Bank, in fact, had raised in an SPP just before that about $820 million, and they've got a larger market cap, and so $750 seemed to be an achievable and appropriate amount. So I just don't accept the sort of inference of your comments that there was some neglect really on the part of the board of retail shareholders. We are concerned at all times to look after the interest of all shareholders, and you do that by looking after the interest of the bank and keeping the bank safe. I've stated before, and I'll state again, we would always have a preference for a pro rata rights issue, and so we've foreshadowed that in the event we need capital for the acquisition that we mentioned today, we'll do that through a pro rata rights issue, which is the sensible way to do it. You know, if you got into your argument about doing a retail only because of the dilution, I suspect the institutions would come forward and say, well, what about all the money we subscribed at $20 and watched as the share price was $16 something for the next 4 months? We'd like to make up for that as well. You make these decisions at the time based on your best judgment as a group of directors, and I firmly believe that the decisions that were taken last year were the right ones.